It's my great pleasure to welcome you all to today's Golden Meadow webinar. We're joined by John Seguin. John, hello.
Hello.
John is a legendary Chicago Board of Trade and Chicago Mercantile Exchange floor trader with over 32 years of institutional experience. During his career, John traded with major dealer firms like DCNY, Greenwich Capital, Sanwa Bank, and FIMAT, which is a French financial services company, and for 2 decades executed trades in the Treasury futures pits, the very birthplace of institutional futures trading. John is the creator of the MacroGraph system, a proprietary methodology. His work has been published across the US and Europe, and CNBC's Rick Santelli once called his approach the most creative charting he has ever come upon. Today, John will take us inside his system, showing us how extending market profile across multiple timeframes can reveal high probability opportunities, and how to protect traders on both the bullish and bearish side of the market. We'll see some analysis today. We'll explore John's systematic approach to risk management and get the chance to ask him questions directly. This is a rare opportunity today to learn from someone who has not only studied the markets, but stood right in the pits where trading history has been made. By the way, John's analyses are also on Golden Meadow. They are to be found in his space, which is called the MacroGraph Report. They are also part of Golden Meadow's Diamond package, so please be sure to check that out. Just follow the links in the webinar chat window. I would also, before we get right into it, I would also like to emphasize that John has had 2 recent successes with the XLB, which is a material sector ETF, and eBay, taking profit from both. So John, welcome again. And let's start off with the MacroGraph, this methodology and approach of yours.
Okay.
What is it? What makes it unique? Let's maybe cover some momentum, how you define risk, timing, entry, and exits. So over to you, John.
Thanks, Dominic. I just want to make sure that you're seeing my screen first.
Yes, I
Okay.
can see it. Yep.
Okay. So this is a list. So as a broker for those about over 20 years on the trading floor, and then still dealing with professional traders outside of that, or from, I think I left in 2002, and I've been still working with professional traders. One of the things that I used to get calls on the trading floor from all over the world, in the States, Europe, Japan, asking me what was going on in the trading pit. So I would relay who was buying, who was selling. So we're always paying attention to the broker's hands, which way they're facing. You could tell if they were buying or selling, or if you could see the broker's palms, let's say, you knew that they were trying to buy. So this was really valuable information. And when I started in this business, I really started off as a technician, technical analysis. And I came upon a thing called market profile, and it really changed me from just a regular technical analyst. Everybody on the trading floor was using the same methods for charting. And I, by accident one day, went to the grain room at the Chicago Board of Trade and saw a guy make a market profile. So I read up on it. I went to the Market Logic school, and it changed me it really made my career skyrocket because it was a whole new approach to trading. Along the way, though, because I was talking to these professional traders, this list that you see here are the things that I was asked most often. So I figure if I'm going to be able to create strategies, I got to be able to think like a professional. So one of the first things that I talk about is you have to understand event risk or the fundamentals come first. No matter how solid you are at technicals, it really doesn't matter when it comes, because fundamentals trump any technicals there are. So if there's an employment report or inflation figure or earnings or a crop report, those things. Understanding fair value to me is the foundation for what I do. And for me, for the systems that I built for trading, all begin with fair value. I'll show you a little bit about that in a minute. It's really just a standard deviation of volume tracking. It's the value area, the high and the low is essentially where the high is where sellers were fighting that day or defending their territory, and the value area low is where buyers were. And from that, understanding fair value, I can read momentum. So the techniques that I use, I'll show you in a minute, where I'm trying to translate what I saw on the trading floor into a chart. And so I use 30-minute charts to break down price action to find what the institutional traders are doing or which way the big money flows are going. So controlling momentum, who's in charge of that? Is the timing right for a trend? So some customer might call up and say, hey, I'm thinking about getting long here. And I might say, yeah, you know what? I think this thing is ripe and ready to go. There's certain patterns that occur when markets are ready to trend. I think of two things when I think of trading, or right? Is the market running or resting? So if it's about to trend, that's the run phase. Then it rests, then it runs. That's really all markets do, if you break it down simply. Is the market too rich or cheap? That means, is it overbought or oversold? You don't want to be buying overbought markets or selling oversold markets. Out of experience in trading, I had to come up with a method for that. You really need to be able to gauge when a market's gone too far, too fast. I would say 4 out of 5 times you buy an overbought market, you're going to get burned on it, or sell an oversold market, you're probably going to lose money. What are support resistance levels? This is something I think you can hone this craft. If by watching charts, just always looking left on your chart to see the history, what happened when this market bottomed out, where was it, what happened the last time it was here. So I use old high volume prices and acceleration points for that. Defining risk. Valuaries are incredible for defining risk too, in any time frame, from day, week, month, quarter, doesn't matter. And then how you manage a trade. How do I protect that profit as the market's moving in my favor? So that's really what, to me, really focus on that when I'm writing newsletters. These are questions I go over every single day. Now, I've tried all the technical tools. I urge you to be careful when you're looking at, I've tested all these, looked at them, and what I did was I just said, you know what, if you get too many signals or too many indicators, it can be like overload. So I urge you to just pick the things that tell you if the market's overbought, oversold, or trend strength, or reverse, something like stochastics for reversals. Try and keep it as simple as possible. I spent a lot of time traveling with an economist, so I learned a lot about event risk or fundamentals that move markets. Technical analysis, you need it between fundamental events, but essentially fundamentals are what move markets. Between there, though, we want to be technically sound. And I've pretty much researched every technical tool or indicator that's been out there, and I really stuck to one that I learned back in the mid-'80s called Market Profile. It gave me a new dimension where I could actually track what's known as time at price, or actually volume at price. And it gave me a dimension for measuring, which is an integral part of how I develop systems. So understanding fair value is a derivative of market profile. That's the foundation. From that, I can determine who's in control of momentum. Now, when I was on the trading floor, I could see momentum. All I had to do was watch the brokers to see which way their hands were facing, knowing, hey, that's JP Morgan's broker. I've seen his palms. That means he's buying. Or if I saw his knuckles, meaning he was offering or trying to sell the market. But that kind of information is not available anymore since we don't have trading floors. However, I do have a method for tracking institutional traders. I use intraday charts, 30-minute charts that best depict what I used to see on a trading floor. And I'll show you that in a little bit here. So who controls momentum? How do I do that? Is the timing right for a trend? In other words, I might get a customer who says, listen, I don't really, I think I want to get long here. Is that you think the market's ripe for trending? I call it rest or run. And markets go through rest periods right before they run. So that's something I needed to learn to measure if a market was ripe for a trend. Also, if a market's gone too far too fast, in other words, thought to be overbought or oversold. That's key, because you don't want to buy overbought markets or sell oversold markets. You're generally 4 to 5 times you're probably going to lose money. I think this is a craft you can hone, learning how to determine support resistance levels, where you want to buy, where you want to sell, and then defining risk. Valuaries are very good for that too. And I'm not talking just daily valuaries. I'm talking about days, weeks, months, or any time frame. I built a charting program that allows me to track fair value in pretty much any time frame I choose. And then also, how do you manage a trade? All these things, how do you manage a trade? How do I lock in profits? Maybe implement a trailing stop method, which I actually have. So these are the things that I figured I've got to really learn to do to become a professional and actually go out on my own. I urge you to, when you are getting or looking for indicators, to get indicators that are actually meaningful. If you overload charts, I've seen this happen to very good traders where they have so many indicators that they get lost, and it's like a deer in headlights. The ones that I like, trend indicators or strength of trend, which is an RSI. Stochastic is good for if you're looking for turns in the market. If a market's losing momentum, I think stochastics and MACDs are pretty good. But I try and make it. In fact, I built my own stuff. I built my own stuff out of just learning it. So what I did was I researched a lot of stuff, and I took the best of what the tools I researched, and I got rid of the other stuff. So I could make it my own. And what I have here is what I call my trader's toolbox. And this thing, I've been building on this for, 40 years, I want to say. So it's all the things that I learned just by watching trading pits, talking to traders, professional traders around the globe. Any kind of, like, I was a sponge for information because I really did not study this in college, but I did go to the Board of Trade for a summer job, and I bet I was there 15 minutes. It looked like it was just craziness, people jumping up and down. If you ever watch Trading Places, it really is like that sometimes.
This is the human dynamic, right, John, that is now missing, right? We can't get those signals.
No, but I can tell you, man, if something happens, if it hit a critical level, the noise level jumps up. It'd be like a goal in soccer or football. It'd be like the noises and the loudness. This is why we had to use hand signals, because you couldn't talk to anybody. It was just too loud. But the information you could get on the trading floor, as a matter of fact, let me just tell you, when I was on the floor for 15 minutes, I'm walking over to where I'm going to be taking this job, and I get smacked in the back, and I turn around, and it's a girl about a foot shorter than me, and she said, "Get the blank out of my way." And I just thought, wow, this place is great, because it was just really exciting. So anyway, I never left. I went there for a summer job and never left. But these are all the technical tools that I've really indicated, and my favorites are on top here. I did an AI search and asked what's the best technical indicators for a trader. Believe it or not, my top 3 were on there. Stochastics, MACDs, and RSI were in the top of the list. But all the little things that I learned, like how can I tell if something's about to go directional, meaning up or down? Didn't really care. When does it look like when a market's ready to change direction? How do I gauge overbought and oversold? How do I recognize consolidation periods and whether that market's wound too tight or really ready to, if it's wound too tight or gone too far too fast? Different tendencies of what the institutional traders would do. You can tell when they're in or out of the market. Certainly defining risk, different ways to define risk. When do I enter or where do I enter? That's key. That if your trade location or your timing is very good, you actually reduce risk and increase profit potential if you understand how important it is to gauge the timing of entry. And then setting different targets. There's so much you need to know, but by going over this stuff day in and day out for years, it really has become instinctual for me that I can just look at a chart and just come and have an opinion almost immediately. It doesn't take me long to form an opinion on that.
John, just to interject for a second, because when we talked before the webinar, we talked yesterday as well, and this is just an FYI for the audience, is that you mentioned that when you are thinking of swing trading, you are taking a week into consideration when it comes to a time window, right?
That's correct. So yeah, I did that high frequency trading where you're in, you're out in a proprietary trading shop, and it's exhausting. And since then, computers have become such a big part of high frequency trading that I don't think anybody can outclick a computer. So I've gotten away from that day trading mentality, and the system that I've come up with that I'm very comfortable with. It's not so much, you could call it a swing trading system, and some would say, so what's a swing trading system? And I think the general answer for that would be, hey, I'm going to be in this trade for 3 to 5 days. Now, that's how you interpret it. To me, a swing trade is what's the length of an average week. So when I want to make a trade, that's what I'm going to be looking for. For instance, on this chart you're looking at here, this gold chart, this bracket that I'm shaking is the length of an average week. So that's what when I put on a trade, that's about the distance I want it to go. Sometimes the market will travel the length of an average week in 2 days. And sometimes it'll take 5. I don't really think about it as a time factor. I think about it as a distance factor. So when a market breaks free, like here in gold, one of my favorite setups is I've got 4 or 5, these are value areas, right? This is a standard, each box is a standard deviation of volume for that day. And each day of the week is shaded a different color, and I'll show you why that's meaningful in a little bit. And also, when I see 3 to 5 days of these value areas that are overlapping and very tight, that tells me that this market is ripe and ready to run. And so this is what I took from the trading floor. When buyers are in charge, generally, you'll see the low made in the first hour of the day. These yellow shaded candles that you're looking at, that's the first hour of regular trading, right? So when the market opens up, there's this sort of jockeying for positions. You can see the broker's hands. Let's say the market, I'm seeing the palms. I'm seeing all the brokers are trying to buy. I can see their palms. And then all of a sudden, it goes high enough, and now I see the knuckles. Now sellers are in there. And then it would go down again, and then the palms would show up, then the knuckles. And this is a battle that plays out for about an hour after the opening bell. So that generally when markets are strong, you're going to see the lows made in the first hour of the day. You see that in gold here. The lows are being made in the first hour of the day on the trend up, right? And you'll see an extension higher after that first hour, which is a sign that the bulls overtook the bears in that early sort of battle that played out. So that's 2 things I look for reading momentum or discovering which way the institutional traders are leaning. 1, when was the low or the high made? If the high's made in the first hour, generally means sellers have the edge. When lows are, means buyers do. The extension after that first hour is my second read on momentum. Generally, when a market busts through that other side from the first hour, it's an indication. It really is pretty violent sometimes. It means that the sellers are just capitulated. They've given up the fight they had earlier, and then the sellers are turning around to buy because they got to cover their shorts, and the buyers are getting long. So this is where you see that crazy stuff where everybody's jumping up and down and trying to get out of trades and trying to get into trades, and the moves can be really violent. And violent moves look a lot like this, where you see where here it breaks through, and you see these candles that they're long bodies and short wicks, but that's what I call acceleration points or sprints. It's like a sprint from fair value, and it leaves behind these little fingerprints, and that's what dominance looks like, right? So that's why I break down my days into 30-minute charts, because it reminds me of my days on the pit. It best depicts that noise that I used to see and like the early skirmishes. So this is my daily worksheet. When I write my newsletters for futures every day, this is my worksheet. Yeah. So when the market, and think about it this way too, when the market's going higher, lows are made early, extensions higher, and the market, you can see here, gold is closing above the value area pretty much every day. When I think about trading, I think about, hey, our trends. Has this market gone high enough to entice sellers, or has it gone low enough to attract buyers? And if the market is closing above the value area every day, which is, again, a standard deviation of volume around the mode or high volume price, that tells me that there's a high probability that this market is going to continue on that path the next day in search of sellers. Now, here's a neat thing. When the great thing about value, you talk about risk. When a market really gives me a strong signal, low made in the first hour, extension higher, close above value, I've got about an 80% chance this market is going to go higher the next day. What's my risk? Once I get that signal, my risk is, hey, if I'm betting the market is going to stay above the value area, my risk is defined by that value area. Then the next day I move it to here. Then the next day to here. And I just keep using the value area to define my risk. You're talking about this gold trade here that lasted about all that money that when that trade really kicked in. Let me just show you what I'm talking about. So the signal to me comes clear on this Wednesday. And I like buying when the market extends after the first hour, because 70% of the time, the higher the low is made in the first hour of the day. This market, actually, the time you get stopped out at, this was what, a 5-day trade for just one gold contract. You made over $18,000. following that method, say, hey, the market has not gone high enough to attract sellers. And so I use the valuers to define risk to lock in profit. That's exactly the system that I send out to Golden Meadow every day. It's built on that. This is the sheet that I send out, and it gives you a buy side and a sell side. And if the market gets above the buy side, you set your risk. And then when you hit the first target, your risk goes to your stop goes to the original buy price. So let's say you bought 40 of something here, or 40 of Pepsi. So you get in at 59.24 when it goes above there, 59.25 when it gets above that. Set your risk, which is about what, 54 cents, right? And then when it hits the first target, my stop is going to change to where I bought it. So now, let's say I bought 40. I get out of 10 of them at target 1. And then I move my stop on the 30 to cost. And then when I hit target 2, I take that stop and I move it to target 1. So now if it backs up on me, so if I hit target 2, I take 10 more off and I get my stop is here. Worst case scenario, I'm still going to be making some pretty good money on this trade, $1.10 or something. I'm going to be making on this trade. And if it gets to target 3, the stop loss on the last 10 goes to the previous target. So this is the trailing stop method that I was able to come up with that is similar to what I'm showing you here. That I'm trying to, I can use value areas to define risk. And until, as the market's trending higher, until a value area low is violated, I'm staying with this trade. And if the market's going down, I just use the value area highs to define risk. So this is all built upon, hey, why does that work? This is where buyers put up a fight. And this is where sellers did. And sellers gave up. And they gave up again here. And they gave up again here. You know what I mean? So this is how you read momentum and understand how the pros, which way they're leaning, and the standard deviations, which is a market profile thing, really changed me as an analyst, because now I knew exactly how to at least start to define risk. To me, I'm really risk averse. So I want to reduce my risk to nothing as soon as I possibly can.
John, how about we take a very current example, something that's happening right now. I'll just ask because Nvidia, I was reading today that Nvidia is going to invest approximately $5 billion in Intel to co-develop data centers and PC chips. And if they're co-developing chips, 2 different companies, that's a big structural move. So from a MacroGraph perspective, how would you analyze something like that? What time frames, or would you check to see if this is like a sustainable breakout based on this news, or it's just like a news spike?
So I'm looking at an Nvidia chart right now, okay? Mm-hmm. And so when I look at it now, I'm still looking at a 30-minute chart. So one of the things that I believe is super important is to try and find structure when there doesn't appear to be any structure. In other words, I try to find, where's that slide? Here, this. I look for this. Where markets are coiling up, the 2 structures you look for are known as flags and pennants, or just channels, right? And that's like a value area to me. So what I do in charts is I look for structure when there doesn't appear to be any. And in this Nvidia chart here, I can see structure right here. This is a fair value area that I'm, wait a second, a fair value area. There we go. Like that. I don't do the absolute highs or the absolute lows. I'm looking for the guts where most of the volume is. So now I know with Nvidia, it's really stuck in neutral, but it's had a great run, and this could go into a holding pattern for quite some time because, like I said, markets run, then they rest. And this was an incredible run from $110 to $180 in really May, June, and July. And now we're in the second month of rest. So I would tell you this, a weekly close below this 170 level, I think would be a negative. And as long as it's above 170, that this thing eventually will go on to new heights. That's how I read this one. Let me do something here for you. Yeah. So I'm going to just do an Nvidia chart here to show you how I would look at that. I'll go back maybe 12 weeks or something. So what you're going to see here, this is a MacroGraph. This is from my website. And what this tells me, you can see here that all this volume since going back to July has really been in about a $10 to $15 range. This is, if I go even, let me just do this by month. Maybe that'll be a better look. I'll just do 7 months.
So I can see the colors there representing different days of the week.
Yeah, so when I'm looking at a weekly chart, each day of the week is shaded. So Mondays are always purple and Fridays are green, right? So I can see time in these charts. So here's Nvidia, and actually this is a very good example. This is a monthly one. So Mondays and the first week of every month are the same color. So I look at a chart and I can see, boy, first week of the month, this thing made a low. First week of the month, first week of the month, first week of the month. That's when markets are rallying, you tend to see lows made either Mondays or early Tuesdays. It's the same thing by months.
So we're talking about volume here, right, John?
What's that?
We're talking about volume here, right?
Oh, yeah. So yes. This is on this chart, the left to right measurement is called time at price. And that's the visual here. This is the digital. So what I do is I look for markets that have an above average time at price. In other words, the horizontal measurement, and below average value area. When I get that combination is when I see explosive moves. So my whole system is built upon finding markets that are wound way too tight. My directional system, I also have a counter trading one, but my directional system is looking for markets that have spent too much time at price, thus making them ripe to go again. And you'll notice something here too. This happens by the week also. When markets are strong, they tend to close at or above the high volume price. That's what I'm over right now. That's the high volume price of May. Here's the high volume price in June. And because the market went up for about four months straight, now I believe it's entered into a rest phase, which could go into, I think, October even. But then maybe be ready for a late year rally again. This is what markets do. They run, then they rest for a while. And here's what I look at digitally. This is what my program does. I look for, so for example, the average time at price is 45 hits. And so I look for the ones that are far above average. And here we go in May. Wow, 53. So that's above average. The value area difference, actually it was more like June. Value area difference, when the value area is really small, the time at price is really large, the odds for a breakout are very high. That's all I search for. I'll go through the S&P 500, a bunch of futures, ETFs, and tell me to kick out this. And so today, all I got was two companies, Pepsi and GM, that said looks like they're ripe and ready to go. So let's just do an experiment here to show you.
But John, that's barring external factors, right? If there's some sort of negative news which could
you can't account for that. You can't account for that. If news comes out, that's just part of trading. But if it's an event like earnings, I don't recommend trading on an earnings day. Even if you have a good signal, like I will never trade treasuries or interest rate products, securities, never when there's an employment report coming out or an inflation figure. These are things that you want to avoid simply because, shucks, I didn't mean to do that. These are things you want to, because you don't have any control. Fundamentals are more important than anything. So you must be aware. Look at your event calendar every day, and then you'll know what I'm talking about. That you say, oh, okay, I'm gonna. It's like a pothole, man. You just want to avoid days like that. So this is why I got a GM signal today. You can see the distance from left to right here in GM looks extraordinary compared to all the others, except for this one maybe down here at the end of July. So when I see that much time at price, so the average time at price here is about 22 or 23, 22. Here in the last day in July, I got a measurement of 29, which is well above the norm. And then the next week, these are just 5-day increments. These are not weeks. I track every 5 days. And then I take one off and move to the next one. So it's not like Monday to Friday measurements. It's every 5 days. And so every once in a while, one will pop up where you see a lot of time at price, and then you go on a 15-day run. Then you rest for a while. This looks like an Nvidia chart by month, but it's the same thing. Markets rest, they run, they rest again. So now with GM, I've got the measurement of 23 time at price, and right now it's at 34. So this is why I got a signal on it. It's far above average, meaning that we should be within the next 24, 48 hours. GM should be on the run, and I'll take a look at that in a minute. The other part of the equation is a lot of time at price and the size of the value area. That's what VDIF means, value area difference. And if that's below average, time at price above average, and value area difference is below average, which here it is well below average. And then the next factor or variable is range. Is the range below average? The range is below average, the VDIF is below average, and the time at price is above average. That's the combination for finding markets that are ready to break out. So that's what I search for. And so let's just take a look maybe at GM today. I don't know what it did. I haven't looked at it, but my system was telling me that there could be a move in GM today. Let's see if anything happened. I honestly don't know. It looks like it opened up above value and came in. I don't take those trades. So if I have my buy and sell level in GM, so I have 59.24, somewhere right there, and the sell level was 58.50, something like that. So that's roughly my value area. If a market opens up above it and comes down in here, I don't buy it. If the market opens up within those two barriers, then it breaks out. That's when the strong signals come. There was another one I had today. This is GM. That doesn't seem right. Oh, I messed up there. Let's try Pepsi. That was, yeah, I think I messed something up there. But let's just take a look at Pepsi. This is the one. So GM, it should be 59.24. Now Pepsi, you can see Pepsi's wound up here, and it hasn't broken out yet. So on Monday, I'll probably get that signal again, looking for Pepsi to break above 141.80, and then that would tell me there's a good chance this thing's going to go vertical for a while. So that's all the system does, is drives me to markets that are ready. In other words, the timing is right for a trend. So that's what I share with Golden Meadow. And I've been practicing for a while. I'm going to be running some back testing on this thing going back about 3 years for all the S&P and all the other futures and everything. And hopefully I'll be able to come up with, I guess I could just show you this here. Yeah, let me share something with you. Get rid of that. So this is my actual worksheet, and I'll explain to you how it works, and maybe you'll feel, well, a little bit more comfortable. So this is the one I mainly run for futures. But what it has is a unique feature. So this way I can change the time at price. I can change the time at price, the value area difference, and the range. Go, okay, these are the numbers I'm going to start with, and I'll have a benchmark set. Then I'll tweak it a little bit and say, okay, I want to get less signals or I want to get more signals, and I can change those percentages. My risk levels are defined. I can change those, and I can alter the profit targets. So there's a lot of back testing that needs to be done, but almost by mistake, I found something unique. That if I'm not getting signals, right? So this one's telling me, okay, we're going to be trading target or whatever it comes up. What's unique? What I found was, I was talking to my son. He helped me build this. He did most of the computer work. I wrote out the logic. But I found another one that gives me overbought and oversold. So it's the opposite of what I've just talked about, the breakout signals. So I also have this feature here that tells me, hey, this market's going too far too fast. Look for a way to have a counter trading methodology. So the best of both worlds for me is I only look for two trades: markets that are wound too tight or markets that have gone too far too fast. That's where I feel, that's when markets are abnormal. And because I'm a little bit abnormal, that kind of fits me. That I look for, normal is difficult to trade. When things get out of hand, wound too tight or gone too far too fast, that's where I believe there's opportunity. You'd be surprised. Especially I learned this watching a trading pit. When market's going up and it's screaming up and everybody in the room is trying to buy it, and if you watch Trading Places, it's so true how it happens. The market goes up, and then all of a sudden I'm seeing everything I'm looking at. I'm seeing palms. Every trader's trying to bomb. And then all of a sudden I see knuckles start to show up. I see sellers are showing up. And then I go, okay, now I can hit it, because now everybody's going to panic and go the other way. That was such a luxury on the trading floor to be able to see that. But I think you can see it on screens. Go
Just
ahead.
hold that thought for a second, John. Then, speaking about opportunities, then if we take 52-week highs into consideration, for example, and when stocks are nearing their highs and they're getting attention in the media, do you view those as, for example, more risky for swing trades because of potential resistance, or do you view them as potential opportunities because of this breakout potential, since we're already on this subject here?
I guess we could go back to Nvidia and go over
Mhm.
that. So how I would take that, because there's been a lot of good news there, like you said, right?
Yes.
So why didn't it punch through the old highs then? This is where the technicals play a big role. So for me, how do I know that I can get back in on Nvidia? Man, I want to see this market break through here. I'll just go to a daily chart. What the heck? So you can see the extraordinary. Look what happens here. A good run and then probably a few weeks of rest, right? A decent run, some more rest. Then it rested for a while. Not then it goes on this huge run. So look at some of these rest periods go from 2-3 months sometimes. So I'll tell you, when do you know it's over? For me, if I were to look at this, because I'm always looking for structure in charts, right? And I can see a lot of volume right in here, just just simply because you can see the overlap in price. So what I would be looking for is when I see this market get to this level here, right? When it gets to that level there, then I go to my short-term stuff and go, when it broke through here, did I see a low in the first hour of the day? Yes, I did. Did I see an extension higher after the first hour? Yes, I did. Did the market close above that day's value? Or yes, I did. So get long. You've broken through a long-term structure and you got a short-term signal with the way that I mentioned on how I read momentum. I want to see those three things happen as it breaks through a value area high, a long-term value area. Then I feel like I've got something. So this to me was, okay, man, it broke through. How far is it going to go? I don't know how far it's going to go. It went $30. And then I started seeing highs made in the first hour. And you see the big red candles there. That's a way you can tell, okay, it's shifting to neutral. So I would tell you this: if you're looking and you like the news you're hearing about Nvidia, and I don't know how you couldn't, that what I would like to see is when it gets through, if it gets through 182.50, and when it does that, did I get that was a low made in the first hour? Did it extend higher? That's a very strong signal that there's institutional participation. So I almost would say, do I guess that it's going to happen, or do I wait for it to happen? And to me, I like the confirmation of it. That's what I believe a good system is built upon. You look for the structure, and then and then you let your short-term stuff that I talked about earlier, let the short-term stuff give you the answer. Was that right? Or for instance, like with gold, I'll just go back to that because it's pretty easy. Gold's had a nice trend recently. There's been a lot of chop in other places, but yeah. So as we get through a structure, am I seeing lows made early, extensions higher, close above value? Man, this thing could go on. And think about it this way: when markets are winding up, so right now gold is in this about a 9-day wind up after a big run and a rest. When I think about consolidation period, so it's been in a week's range for 10 days now, an average week's range. This is a market that's getting wound up again. Think of it as pent up energy. The more time you spend in a structure and with the below average ranges, the more powerful the breakout is likely to be. It's like gunpowder, right? The more time builds up more energy, or spring load, or whatever metaphor you want to use. This is what I search high and low for. And I don't just look for 5-day patterns. Man, I will run it and I'll go, show me what's going on for the last 20 days or what. You got to find a time frame. I found that if I look at futures in 3-day patterns, and if I look at ETFs and stocks in 5-day patterns, that the breakouts usually come within 24 to maybe 48 hours before they're up and running. And so that's why the beautiful thing about scanning or filtering markets is if you have a good idea of what you're looking for and just focus on those markets. You think about the thousands and thousands of markets that are out there and how distracting and how hard it is to find focus on that. Sometimes it's so overwhelming that you can't pull the trigger on a trade. So a lot of folks will go to what's the most popular thing, or the SPY ETF, or whatever the highest volume ones are, and I'll just stay with that. And then you're missing out on these stocks or ETFs that might just come out of the blue. So why not focus on the trading floor? I was in the bond room, so I could really analyze or help people trade bonds. But when the floors closed, I thought, boy, I was really sad. I really loved being down on the trading floor. It was so exhilarating. But then when I got into when the electronics came up, I thought, wow, how fortunate are we now that we get to take, rather than just trade a market because it's in front of you. Like, I'm just strictly a gold trader, or I'm a soybean trader, or whatever it is. And that's what you did. And there's some days you had to make money in markets that were not easy to make money on, that you didn't have a strong feel on it. So I thought it actually was a blessing in disguise to get off the trading floor and be able to scan markets worldwide and just look for certain patterns and instead of trying to make sense out of something that didn't make sense that day or even that week. So you would trade out of boredom because it's the only thing you did. Now we have this luxury to be able to, so that's why I'm a pattern watcher. I look for patterns that I know often lead to large vertical moves or above average vertical moves. So that's all I search for. I learned this. I'll tell you a story. I was on the trading floor and I used to do all my charting by hand. In fact, I could even show you that. But I used to do all my charting by hand. And so I was on the trading floor one day for a couple of weeks, and I remember the markets were just dead quiet, like it was this summer. You go through those dog days of summer of June, July, and even August sometimes, and there's just not a whole lot going on. And then so I'm sitting there and I'm doing my charts, and I'm getting, it looks like this, where it's 1 week, 2 week, 3 week. The markets are really going nowhere. It's just wound tight and ready to go. And then all of a sudden I'm sitting there and Goldman Sachs comes in and starts buying like 500 bonds, then 1,000, then JP Morgan's behind them. And the market exploded and went up for 4, 5, 6 days in a row in a big way. And I thought, oh, that's what momentum is. So momentum to me is the movement away from a fair price. So that's when it came to me. I should look for fair prices. How do I do that? And so I started tracking with, where's that darn thing? So I started tracking markets, or the time at price, that measurement. And then I became really good at picking markets, say, hey man, this thing's ready to go. And I'll just give you an example. This is one of the charts I used to do. This is a 10-year note chart. Oops. I don't think you're going to do that. I opened the wrong app. Anyway, so what it looked like, there was so much time at price, and it left there, and it just never came back. Kind of like this down here on the far left of the chart. Just 3 weeks in a row, the market's gone nowhere, and then boom, you run for 15 days in a row. That's what I'm talking about. That's what it looked like. So I could do it. I saw it visually. I just needed to make it digitally, and that's why I built this website, to be able to. I could only watch like bonds, notes, the S&P, maybe gold. I could only had so much time to coloring, raising 3 kids. This is where it started. So here you go. Let me get rid of this one. I'm going to open this up in another app, because this is really where it started for me, guys. I'm showing you my origins of this, and let me just make this a little bit clearer for you. Open with that guy.
So this is when you were
I was the trading floor
doing this by hand here.
Yeah. So this is a 10-year note chart, and these are market profiles. This is what they look like. It's instead of using bars, you every 30-minute period of the day had a letter of the alphabet. But then instead of putting them adjacent to each other, you stack them on top of each other, and then you get that horizontal measurement. That's where that originated from. So I would fill in these little letters with a pencil for a number of different markets. And so you can see the high volume prices were right here. That's where these little blue lines were right there. I don't know if you can see that a little bit deeper. Anyway, my value areas were red. The first hour range was black. And you can see here, I've got days in a row right here where let me make that a little bit bigger. There we go. So you can see here, all that, look at all the high volume prices are right on top of each other, right before what happens, you know? Look at that explosive move. Then that thing went up for days and days in a row. Here, I keep down all the fundamental data, right? The employment report, there was a federal, when Greenspan was Fed chief here, retail sales, really important data. So I was watching that. I also came up with, you know what, I wanted to make a moving average too. So I made this blue line as a 5-day moving average, and this thing was great. I love the 5-day moving average, but I used to use 5 days of the high volume prices. So it was a very smooth moving average. Then I had a 20 days. So I had a week and a month, and then I actually watched a quarterly one too. I didn't really use that one that much. But then I had an exponential one. I've got a 5-day here, but I had a 5-day exponential, which was weighted towards the most recent data. And this is how MACDs work for me. If the distance between the exponential or weighted and the simple moving average, if that was a nice, they're right on top of each other, that's a strong trend. It's when they got too separated, like the 5 and the 20 got too distant, that's your moving average divergence, right? And when it got too tight, like it was back in here, moving average convergence. So when it converges, get ready for divergence. And then you go back to do the same thing. So that's my way of looking at MACDs. I don't actually use MACDs that often. I can just look at the difference between two short-term moving averages. And I can tell that's too far, too fast, or whatever the case might be. So from that, guys, and this is all, the reason why I'm showing you this is because this is the origins for all this other stuff that I came up with. First, it was the days. So you're looking at days here for the S&P futures. And you can see how the valuers are very good support on the rally up. And then we had the FOMC meeting on Wednesday, and it halted the trend. And then I thought, okay, let me do weeks. So then I started doing weeks in my charts. And that's where I was using colors. So let me show you. I think it's this one. Oh, don't do that, John. This is let me get rid of this. I got to get this app off. Takes up too much room.
John, when are those charts from? Actually, those printouts that you have there.
This is today.
The previous ones that you.
Oh, you mean? Yeah, the hand chart.
Yeah. Those historical ones. Yeah.
I'm going to say this one was probably back. What a nut job. Yeah, I'll bring it back up. I want to say it looked like 2003, maybe. Mm-hmm. So I'm looking at it. So it's the June contract. It looks like of 2003. But I started doing these things in the late 80s. But I think I've got a screw loose because I did these things by hand for years. And even when I left the trading floor, I still kept doing them by hand until I was able to actually get some guys to. I started building the program when I was at San Juan Bank. I would fly to New York a couple times a month and work with a programmer. And the first version of the color charts came out in the 90s. And so I think the first version was better. This one's sufficient. It does what I need. But this one originated, I'll show you here. Open with you. So this is a 5-year note chart. And now this is when I started doing it by weeks. And so I would do a shortened version of it, where Mondays were always purple and Tuesday orange. So the color schemes never changed. So this is where I started watching the weekly ones, and there's my 20-day moving average. And so I started seeing the patterns in the weeks looked a lot like the daily ones. And it was from that. Let me see if there's another one here.
So basically, this is how the MacroGraph started taking shape.
Yes. So I had the idea for years, but I wasn't able to. I was so restricted because it was all these charts were being done by hand. So I was really restricted to be able to go out and analyze many markets, because once I got off the trading floor, I knew darn well that the best thing to do is to be able to scan many markets. Now here I'm going into weeks, and you can see the same pattern. Patterns repeat in all time frames and in all markets. It could be by a week, it could be by a month, it could be any time frame. It's just simply finding markets that are wound too tight or that have gone too far too fast. And so you see gold or GLD, the ETF GLD. Look at how wound tight it is down here. And then it went on a 3-week run and it just recently shifted to neutral. And then I thought, well, if it works by week, why wouldn't it work by month? And so here's the S&P or SPY, and you can see the value area lows are holding. The market's closing at or above the high volume price every month, right? So,
John, when you say wound tight, just for anybody who might
yeah,
not, what do you mean by that?
when it's wound tight, it's when I get that measurement from left to as far above average, and the value area is below average as well.
Okay.
So that's what I really focus on is the left to right measurement, then the value area, and then if the range I don't put a lot of weight on. But if I see this structure, so for example, this box you're seeing in this chart, this is the average area of a month, the height and the width. So what I do every month, and I actually do it every weekend, is I will make these things and go, okay, this market, you know what? I finally get a really good buy signal. I'm going to measure, and you see what happens. It gets to about an average width, and then it takes off again. And then it gets to, so once it hits that average width, get ready for the vertical move. And when the move is too big, far above average, right? Like here, that's almost twice. That was April when the tariffs were announced and then delayed. But we had like almost twice an average month's range. And that usually leads to a period of consolidation, which we had a big move in the beginning of April, and then it did nothing the rest of the month. It was bouncing around, but going really nowhere. I guess to tell you is when I see markets going far above average time at price, then I know it's ready to go. Here, it just got a little bit above average, but then I start looking at my short-term stuff. Was the low made in the first hour? Yeah, it was. Is it wound tight? Yes, it is. So low made first hour, extension higher, close above value, get in there and get this, and maybe I can make an average month's range out of it. So when you're looking at monthly charts, you're shooting for monthly ranges. When you're looking at weeklies and then even quarterlies. This is gold. Look at this one here. Look at how wound tight that is. All that time at price, far below average value area, and that was the onset of a massive trend that hasn't begun. And this is worth, in the future, it's got to be worth hundreds of thousands of dollars for one contract. That's how, and so the quarterly ones, if you're a long-term trader, you want to I look at the long-term ones all the time. The value areas are holding the lows, staying above that. There's no reason for me to be out of it. And now to finish out the fourth quarter, I still can't think about a reason to be out of gold. The trend is still healthy. I think it's going into a holding pattern myself. But look at that. When did this market take off? When did it take off? In the first 2 weeks of this quarter, or first 2 months of this quarter, July and August, the time at price had already surpassed the norm. What happened then when you get into SEP? It took off and made a massive vertical move. Here's the opposite of that. Look at this one right here. In April, the first month in the second quarter, the whole range, it surpassed the entire range in the first month. What did it do the next 2 months? Nothing. So think about this as an option trader. When you see too much length, think about neutral option strategies where you sell iron condors and butterflies or straddles and strangles. And when you have markets that haven't moved anywhere, like here, it's far below average, meaning the next quarter is likely to be at or above average. So that's the transitions that I look for. Too much time at price, it's going vertical. Too little or too small of a range or too big of a range, it's going to go sideways. And then you can apply the trading strategy for that. So it doesn't matter the time frame, guys. You're seeing it. Markets make bell curves. From that normal bell curve, you can say, yeah, it's ready to bust out, or you can say, wow, it's gone too far too fast, and I've got to take another strategy. And the whole idea behind it is find a long-term chart, but use this stuff, the short-term stuff, to say, I got my answers. I got the strong signal. You have to think long-term, but you have to have a mechanism for entering the trade. If I see a market that's congested or wound tight over a month, a quarter, or a week, a month, and a quarter, man, I'm looking at my day chart and going, give me one signal Should I be buying this? And right here in gold, it gave a great signal right there. And you see how fast that thing ran for 10 days in a row, where there's just, like I said, that's worth $18,000 just that move in a week. So that's really, I use these long-term ones to look for markets that are about to be explosive. Then I go to the next time frame and see, wow, how does the week look? I kind of work, if you're looking at a market from space, or let's say you're looking at the Earth from space, and you can see where the coastlines, and they're almost straight lines. You can see them, they're not really rigid. But if you, let's say you're looking from a helicopter, and you can see all the nooks and crannies. There's a lot going on there. It's like fractals, right? Markets are fractal, but when they're fractal, there could be organization in chaos. And then
going from macro to micro.
Yeah,
John, I don't want to break your train of thought. I did want to interject here just for a second. I know I said we'd leave questions for our next webinar.
Oh, that's right. Sorry about that, guys.
I did want to just take one. Anonymous here is asking, how long have you been doing this? You've been posting here on Golden Meadow for a few weeks, but I can't find your previous articles. I assume that means online, articles elsewhere online. Do you have any long-term clients? Do you have, I guess this is asking if you have people, John, whom you've worked with,
okay.
You've mentored perhaps.
Yeah, you know what? That's a great question.
That's what I assumed. That's what I assumed that is asking.
Yeah, so I'll tell you this. I still have some clients that I've had for 20, 30 years, guys that still like to trade. But the majority of the people that I've taught or shared signals with and things like that, they're in their 60s, 50s, 60s, and mostly pretty wealthy. They're guys from the trading world, and they're just hanging with their grandkids, and they're just not trading anymore. So my clientele has dropped quite a bit over the years. I'm 65 myself, and so there's not many guys my age that are still really passionate about this. I don't know what I would do if I didn't have this. So and I'm still searching every day. It's still learning new stuff. It never ends.
But passionate people are the best ones to learn from, right?
Yeah, I love it. I love teaching it too, because if I can make a difference in someone's career, and I've gotten feedback on that, like guys that are retired and looking for something to do, and they don't know much about trading. I've trained them so that they can be independent and actually make money out of retirement using the methods, a lot of what I talked about today.
So John, if somebody wants to, let's say, apply the MacroGraph, how would they go about doing this? How does one use your method?
Okay, so I've got a website. It's called MacroGraph.com. If you want to, there are educational videos on there, right? And if you go on there and you hit register, I'll give you a free trial to use the charts. It's not expensive because it's not live data, right? It's more of a research tool. But if you want to learn how to use those colored charts that I showed you, I'll give you access to it. We'll talk about it. I'll probably do it for 3 weeks, give you a run at it. And if you have questions, maybe we can do another webinar. But I don't charge a lot for it because it's not live data. I do it as a service to help people find opportunity. And of course, I've got the signals that I send out through Golden Meadow that are there. So if you just want to focus on, and I put them in order of trend potential. So if you're looking for what market should I focus on today, check the Golden Meadow site, and whatever signals I got that day that market's ready to break out, that's right there for you too. But yeah, if you want to mess around with the tool, learn how to use that, feel free to log in and register, and I'll set you up with the access to the charting program.
What would you say is the learning curve for the MacroGraph? Is it something that, let's be real, right? Is it something that, because a lot of people prefer to just read an analysis, right? So your analysis on Golden Meadow, which by the way is in John's space, the MacroGraph report, which is also part of the Diamond package. So I just wanted to mention that. So please have a look at that, everybody. But how would you define like the difficulty level with the MacroGraph?
You know what? I believe that I can in probably 6 or 7 hours. So I do classes where I teach about an hour a session, and I think in about 6 or 7 hours I can get people to think how to trade logically, how much time they're going to put into trading and that kind of stuff. That's entirely up to them. But to actually go through the paces on how to think like a professional and how to use logic to trade instead of random trend lines or these indicators. Some people use indicators, and I don't think they know what the indicator's for, right? For paper stuff, but they don't even know the logic behind it. I teach the logic behind it on why you should understand fair value and as a foundation, and then build upon that. Because like you've seen in the day, week, month, quarter charts, markets make bell curves. And so that's organizing fractal data. And when you get normal bell curves, good things happen, breakouts, that kind of stuff. Yeah, I think in most of my curriculum is about 6 or 7 sessions and access to the charts and all that other stuff. And so I don't, it depends on the experience of the trader too, or if they're brand new, and it might take a little bit longer, but if you've been looking at charts for a while, I just show people a different way to look at it. It's a little unique, but I can't think of a better way to do it. Market Logic. The first book I read about this was called Markets and Market Logic by Pete Stottlemyre. I've worked with him in his classroom, and it changed my life. It really did take me from being a bar chartist or even a point and figure chartist. And I left all that behind, and for the better part of 40 years, this is what I've been doing and building. This is all unique stuff. So
these chart patterns are very interesting, and I'd like for us to continue this because I don't want this webinar to become broken because we're nearing the end here now. And so let's set up another webinar soon. Let's continue analyzing the patterns, because there's a lot to learn from you here, a ton. And even as I'm listening, I'm trying to actively listen while monitoring things here, but there's so much to learn from you. And please, everybody, prepare some questions for the next webinar that we'll have with John. So John, anything that, before we wrap things up, are there any concluding remarks that you'd like to provide us with?
You know what? If you're going to get in there and mix it up with the pros, because if you're trading with professionals, you better learn to think like one. And I think that's mainly what I try to tell people, is I try to put them on the same field as a pro. What does a pro know? What do they look for? And that's what my focus is on, because I learned from them, and I had to teach them too.
What about the intimidation factor? A lot of this might seem intimidating. Any calming thoughts? Any calming words for those of us who are?
You know what? I think by using this method, it takes the intimidation out of it. I'm actually very calm when I'm trading, because I have a very strong foundation that approach trades the way they are. If I lose, that's going to happen. I expect to win because I have a set of rules that says, okay, you can get in this trade. And I think that probably 3 out of 4 times, I'm probably going to get you in the right direction. I think I'm that good at saying, here's a good trade. I write these newsletters every day. And so this is what I pass out. Aside from the stuff that I've shown you, I'll just show you a real quick example. I think I'm still sharing my screen, right?
Yes, you are.
So I'll just show you. This is something I've been doing for many years. I used to do it for professional traders and fax it along when faxes were the way to communicate. But this is very simply what I do, and it keeps me so engaged. So every morning I write about treasuries or interest rates. I believe interest rates are what make the world go round. So I first write about interest rates and just a short little couple bullet points about, do I have a read on momentum? And if I do, so if I have a good read on momentum and say, hey, listen, you want to buy it against the pivot or sell it against the pivot here today for treasuries? I had sellers show up yesterday. I had a high made early in the day, an extension down, and a soft close, which means the market's probably going to go down today. And so I tell them, sell against the pivot, and there's your first stop and your second goal. If I have a strong opinion, so I do it with treasuries first, then I go to gold, then I do the 3 top equity indexes. These are all futures. And all these markets are connected. So sometimes what happens in treasuries is going to affect the euro, right? Which is the euro moves almost exactly opposite the US dollar. The US dollar is heavily weighted towards the euro. So it's easier to trade the euro because the dollar index it's on the ICE exchange and it's expensive. The data is expensive. So if I feel like I should be getting long dollars, I'll just sell euros. But what happens in interest rates absolutely affects foreign exchange. And foreign exchange absolutely affects gold prices most of the time. Like a weaker dollar, usually you see stronger gold, and vice versa. Also, what happens is interest rates can have a huge impact on the equity indexes themselves. And then I also look at crude oil, and then I write about the grains. Sometimes I'll throw natural gas in there, but soybeans, corn, and wheat, I write about that, but not on. I don't put it on this. I send out individual letters to people that do that only like to trade treasuries, but then there's others that like to trade all the major sectors. And these markets are very liquid. And if you're interested in futures, they have micro contracts. I know futures are scary to a lot of people, and they should be, because the tick sizes can be massive. But they've made micro contracts now, so you can get in there and trade futures cheaply and not put a lot of risk in your portfolio or your trading account. I love trading. When it's real volatile, I'll trade the micro contracts because, yeah, the S&P, let's say.
A significant chunk of your time, John, was spent in the futures market, right?
All of it. I never worked in the stock market. I took the lessons that I learned. I was hired by this company called MTM, which is primarily a stock option company. And their customers or clients were asking for, hey, can you talk about futures? And they brought me on. I took the lessons I learned from futures and I applied it to ETF and stocks, and it works well. If it's built on logic, it'll work in any market. It's not like I have to change what I'm doing. It's just numbers to me. And I honestly don't care if a market goes up or down. And that's the beauty of trading futures. You can get short, you can sell something without even owning it. There's no penalty. Or you can just start off your position long or short. It doesn't matter. So for me, markets are just, I don't really care if they go up or down. Obviously, if I've got a stock portfolio, I want the markets to rally. But you can make boatloads of money in shorting futures, playing both sides of the fence. Just take the signal when you get it. So that's how I think of markets. They're just prices. Are those prices organized? Have they made a normal distribution? Okay, then I think I've got opportunity coming. That kind of thing. I could actually look at a chart and not care if it was a stock or a commodity, and you could have no prices on it, and I could tell you what I think what you should do. I could take the name off a chart and not care, because I follow a really good set of rules. Find order in chaos, and now you've got something. You need to be able to see patterns. I will tell you this, and my wife would contest to this. I have a gift of, I can look at a face, and if I saw that face 20 years ago, I would go, I know that person. I have this, I can recognize patterns even in faces. Like someone that was a child actor and they're 40 years old now, I go, I remember that from Lassie or something like that. I think if you can train yourself to see structure in fractals, you're well on your way to understanding what fair value is. And to me, fair value is the structure in any time frame. That's how I look at it.
John, let's continue this with a webinar soon, a follow-up. We can even devote each webinar to a different subject that we can focus on part of the webinar on a specific subject and then take questions. So let's do that. I would encourage you to sign up for John's MacroGraph reports. There is a free trial available. Just head over there and sign up, read John's analyses. John, thank you very much for being here with us, because this is super educational, man. This is an awesome webinar. I really enjoy listening to you.
Thanks. I appreciate that. I had fun too.
Absolutely. All right, everybody. Again, thank you very much for being here, everyone, and see you soon. Take care.